It's Controlled Trades, and in today's video I'll be discussing reading candlesticks. So let's discuss the basics of candlesticks. Each candle summarizes data for the specified time frame that you are on. So if you are on a 5-minute time frame, each candle shows you data or depicts the data for 5 minutes worth of time. If you're on a daily time frame, each candle depicts data for a day's worth of time. So each candle will show you where the stock opened, where the stock closed, the highest price that the stock reached, and the lowest price that the stock reached for that given period of time. A bullish candle or a green candle shows that price has increased over a period of time. A bearish candle or a red candle shows that price has decreased over a period of time. And each candle represents price action. And price action is essentially who is in control. Are buyers more aggressive or are sellers more aggressive? And the power of price action is that when combined with things like support and resistance, as well as volume, we can get a very accurate sense of where the stock should go or where the stock is likely to go. There is no definite in the stock market, so technical analysis isn't going to guarantee you anything. The stock market is a game of probabilities, and you can use things like candlesticks, volume, support, and resistance, etc., to gain a better idea of where the stock should go, and you can stack the probabilities in your favor. So here on the screen are two candlesticks illustrated. On the right side, we have a bullish candlestick. On the left side, we have a bearish candlestick. So for a bullish candlestick, price opens at the start of the body. The shaded area is what is known as the body, and price closes at the top of the body. So the open for a green candlestick is at the lower end, the low of the body, and the close is at the high of the body. And the reason for that is price increases over the given period of time. So let's say this is a 5-minute candlestick for Apple. Let's say the market opened at 9:30. So that at 9:30, Apple may have opened at $100 here. Apple then was pushed down to a low of $99. Then buyers were more aggressive than the sellers and took it all the way up to a high of, let's say, $102. After it hit $102, sellers became more aggressive and pushed price back down to close at $101. So all of that movement occurred in a 5-minute period. So if this was a 5-minute candlestick, all of this data is being represented in the form of a candlestick for that 5-minute period. Let's look at a bearish candlestick now. So for this red candlestick here, the open is at the top of the body and the close is at the bottom of the body. So here, again, the body is the shaded area, and the wicks, just to note, are the little tails that you see at the top and bottom of the candle. And the wicks just show you buying and selling pressure. We'll get to that in a little bit. So for this bearish candlestick, price opened here, let's say at a price of $101. It pushed up to a high of $102. After it hit $102, sellers became more aggressive. It pushed all the way down to a low of $99, and then buyers became more aggressive again and closed it at a price of $100. So again, this is a red candlestick because price closed lower than it opened. We opened at a price of $101 and closed at a price of $100. So candles tell us a story, and like I said before, it gives us insight into who's in control. So the most important parts of a candle and the most relevant parts of a candle in revealing sentiment are the wicks and the spread of the candle. So an upper wick, that little tail at the top that you guys saw before, shows selling pressure. A lower wick, the lower tail on a candle, shows buying pressure. And the spread of the candle tells us how strong market sentiment is. So if you have a widespread candle, that's saying you have strong market sentiment in the direction of the closing price. So if you see a very large green candle, that's telling us that price is very bullish. If you see a large red candle, that's telling us that price is very bearish. Narrow spreads give us insight into weak sentiment. So if you see a very narrow spread candle, that's telling us that sentiment, buyers and sellers, aren't really too aggressive. And narrow spreads aren't bad. It's just that the stock is taking a break. All stocks need to ebb and flow, meaning that they need to rest, and stocks just can't go 100 miles per hour all the time. So narrow spread candles are actually good because it's showing us that stocks are resting. And then price action, one note that I want to make, price action is useless without context. So if you just see a green candle in the middle of nowhere, that's not going to really tell you anything. You have to combine price action with support and resistance as well as volume to get a holistic view of what's happening. So when I talk about playing breakouts or playing bounces, etc., I'm looking for like lower wick showing buying pressure maybe at a support level, or I'm looking for a very large candle going through a resistance level if I want to play a breakout to the upside. So let's discuss wicks a little bit further. So a lower wick is shown on the left hand side of the screen and an upper wick is shown on the right hand side of the screen. So for the lower wick, we opened at, let's say, $100. Sellers were more aggressive and they pushed it down to a low of $99. Once it hit this low of $99, buyers became more aggressive and pushed price to close back at the $100 mark. So the lower wick, like I said prior, it shows buying pressure. And the reason that is because sellers pushed price down, buyers stepped in at this low and became more aggressive. So we know that buyers are defending this low of $99 and they want to hold that level. An upper wick shows selling pressure. So in this case, we opened up at a price of $99. Buyers pushed it all the way up to a high of $100, and then aggressive sellers took price all the way back down to close back at $99. So in this case, the upper wick shows selling pressure, and the reason that is because sellers were more aggressive here. So buyers tried taking price to a high of $100. They failed to hold the $100 level, and sellers became more aggressive and pushed it back down to the $99 level. So this upper wick shows selling pressure, lower wick shows buying pressure. Now let's just put everything together. The open is where the start of the body is, and this is for a bullish candle. The close is the top of the body. The high is at the end of the upper wick. This part right here is the upper wick. This is the lower wick at the bottom end of the candle. The low is at the very end of the lower wick. And then the spread of the candle is the distance between the open and the close. And like I said, if you see a very large spread, that means you have strong sentiment in the direction of the candle. So if it's a green candle, that means strong bullish sentiment. If it's a red candle, that means strong bearish sentiment. And narrow spreads just mean that the stock is resting and there's no strong sentiment in either direction. So let's just go over some real life examples. So here on SPY, we can see that price came into a support level or a demand zone. I can talk about these zones in another video, but price came down and hit these lows of 362 about, and we start to see lower wicks. On all these candles, each of these candles, you can see lower wick, lower wick, lower wick, lower wick. So what these lower wicks tell us is that buyers are stepping in and becoming more and more aggressive. So if I see this on a chart, and like I said, it depends on the context. If I see this on a chart at a support level or at a resistance level, and I see lower wick showing that buying pressure is occurring and buyers are getting more and more aggressive, then I'm going to go long on this stock. And the opposite happens if I see this at a resistance level. So Netflix has a nice example. On Netflix, we have a 573 resistance level that got formed from this rejection over here. And on Netflix, you can see when price came back into this resistance level, you see an upper wick showing that there is selling pressure. So if I see selling pressure at a resistance level, I'm going to go short because I know that sellers are getting aggressive and starting to push price down. Another way of looking at wicks is its failure in a sort of way. So here, the buyers tried pushing price up, but they failed to hold the highs and price got pushed right back down. So let's look at examples of lower wicks. So here I drew a trend line, and again, like I said, it depends on the context. Here you have a lower wick at an uptrend line. So if I see that buyers are stepping in an uptrend market at a level that I have deemed to be a support level, then I'm going to look to go long. Lower wicks signify buying pressure, and you can see a possible reversal. An example of no wicks would be here on Netflix. We had this resistance level that got tested one time over here, 2 times over here, 3 times, and then 4 times right here. So then the 5th time when we came to this level, we can see that price broke through the level with a strong, large spread candle. Like I said, this spread is the body. You can see that it's a large spread body, so there's strong sentiment, strong bullish sentiment. And then the second thing that you want to know is the wick. Here, I can see that there is no upper wick whatsoever, so there is no selling pressure here. That means that price is likely to continue, because if there are no sellers, who's going to bring price back down? So the way that I look at candles is I first look at the wick to gain a sense of, are buyers stepping in aggressively or a seller stepping in aggressively? And if I see no wick, then I'm just assuming that price is going to continue in the direction that price closed. So if I see a very large green candle with no upper wick, then I'm assuming that price will continue to the upside. If I see a large red candle with no lower wick, I'm assuming that price will continue to the downside. The last example of a large candle with no lower wick would be FedEx. On FedEx, we had a support level that was formed over here, and price broke through the support level, and as you guys can see, there's no lower wick on this candle, showing that there is no buying pressure here. If I see that there's no buying pressure, then I'm going to assume that price is going to continue to the downside. So those are a couple real examples that I wanted to show you guys. If you guys have any questions, please leave them in the comment sections. If you guys have any feedback regarding how I can make the video better, please leave that in the comments as well. And if you guys have any topics that you want me to cover in the future, please comment on that as well. And just to recap, just in case I got confusing at any part of the video, the two things that you want to look at when analyzing candles are the wick and the spread. The wick will show you selling pressure and buying pressure. An upper wick is selling pressure, lower wick is buying pressure. And the spread of the candle tells you how strong sentiment is. So if I see a strong candle to the upside, a large candle to the upside with no upper wick, I'm assuming that price will continue that way. If I see a strong candle to the downside with no lower wick, price will likely continue to the downside. If I see a candle that has a massive upper wick, then I'm assuming that sellers are becoming more and more aggressive and we're likely to see a reversal. And if I see a massive lower wick, then I'm assuming buyers are becoming very aggressive and we're likely to see a reversal to the upside. Hopefully you guys learned something out of this from this video. If you liked the video, please leave a like, and if you want to see more content, please subscribe.